Welcome back to Talk Tickers. All right, today we're diving into Vestis Corp, ticker VSTS. Now, this is a weird one. Their latest earnings report dropped, and on the surface, things looked pretty good. A solid revenue beat, but the stock, it got absolutely hammered. So what on earth did Wall Street see that the rest of us missed? Let's dig in and figure it out.
So this is the big question, right? You've got a company, Vestis Corp, that beats its revenue number, but the stock just tanks, dropping 9%. So what's the deal here? Is this company fundamentally broken? Or is this one of those deep-valued turnaround stories that could make people a lot of money? That's the puzzle we're trying to solve. Okay, so here are the two numbers that tell the whole story, the ones that just threw everybody for a loop. On one hand, you have the good news. Revenue came in at $712 million. That's a beat. That's what you want to see. But then you look at the bottom line, adjusted earnings per share. Wall Street was expecting 6 cents. What did Vestis deliver? 3 cents. That's not just a miss, that's a 50% miss. And that right there is what sent investors running for the exits. All right, so let's get past those headline numbers. We're going to peel back the onion here and see what's really going on, because the market's reaction tells us there's way more to this story. And here it is. This is probably the single most important number to understand. The company reported what looked like revenue growth, right? Well, that was a little misleading. See, they had an extra operating week in the quarter compared to last year. Once you adjust for that, an apples-to-apples comparison, the truth comes out. Their revenue actually shrank by 3.5%. So forget growth. The core business is actually going backward. So you've got a shrinking business. And what else? Oh, just a mountain of debt. Their net leverage ratio is 4.7 times. Now, for those of you who aren't familiar, that is a lot of debt. It's a heavy burden for any company. But when your revenue is actually declining, that's when the alarm bells start ringing. It's a huge red flag and it screams financial risk. And if you look at the rest of their key metrics, it doesn't get any prettier. I mean, look at this. Revenue retention is stuck at about 92%. That means they're constantly losing customers. Churn is a huge issue. Their actual GAAP net loss, it's getting wider year over year. And their profit margins are getting squeezed. No matter how you slice it, this is a company showing signs of stress from, pretty much every direction. Okay, so things look pretty bleak. But what's management's plan? What are they telling investors? Well, they've got a whole new playbook, and they're calling this upcoming year a reset year. This is their big pitch for how they're going to turn this ship around. And their plan really comes down to these three big ideas. First, commercial excellence. That's just a fancy way of saying they're going to get smarter with pricing and, actually try to keep their customers happy to stop that churn. Second, operational excellence. They want to make their plants and their whole organization run better, smoother, cheaper. And third, they're going to optimize their assets and network. Basically fix their messy logistics. It's not a tweak, it's a complete overhaul.
So what's the big prize at the end of all this work? Well, here's the number they're dangling in front of investors, $75 million. That's the annual savings they're targeting by the end of fiscal 26. Now that is a huge, ambitious number. And for a plan like this, it all comes down to one thing: execution.
And to really drive the point home, the CEO, Jim Barber, basically came out and said, quote, "The fourth quarter of 2025 represents the low point for profitability." He's trying to draw a line in the sand, telling Wall Street, we've hit the floor, and now we're on our way back up. The problem is, after everything we've just seen, the market is basically saying, yeah, we'll believe it when we see it. So this is what they're promising for the next year, and this is really interesting. Look at the revenue line. They're guiding to flat or even down 2%. So they're not promising a sales recovery just yet, but look at the other numbers. They expect a massive jump in profitability, in adjusted EBITDA, and they're guiding to $50 to $60 million in free cash flow. That's the entire bull case right there. The big question is, can you really grow your profits that much when your sales are flat? That's a tough trick to pull off.
Okay, so now that we have the numbers and the plan, let's zoom out a bit. Because the market's reaction, that big stock drop, it didn't just come out of nowhere. There's a whole backstory here, a wall of worry, as they say on the street, that we need to understand.
I mean, just look at this chart. It tells you everything you need to know. Year to date, Vestis is down a jaw-dropping 55%. Meanwhile, the industrial sector is up 18%, and the S&P 500 is up almost 13%. This isn't just bad, it's a catastrophic underperformance. You can imagine that any investor who's held this stock is completely out of patience by now.
And it's been a bumpy ride ever since they became their own company.
They were spun out from Aramark in late 2023. Then in 2024, they got a takeover bid from a competitor which sent the stock flying for a bit. But at the same time, they're dealing with an ongoing class action lawsuit. And now this huge earnings miss that craters the stock again, it's just been one thing after another, a really volatile and messy history for a new company.
So let's just lay out all the worries, the reasons investors are so scared. Number 1, a ton of debt on a business that's shrinking. Bad combo. Number 2, they have this huge $75 million turnaround plan. Can they actually pull it off? That's a huge question mark. 3, they can't seem to stop losing customers. 4, are those profit goals even realistic if sales aren't growing? And finally, you've got this class action lawsuit hanging over everything. You add it all up, and yeah, you can see why people are nervous.
All right, so we've looked at the good, the bad, and the ugly. So what's the takeaway? What's the call here? Let's put on our analyst hats and put together a rating and even a potential trade idea.
So here at Talk Tickers, our official rating is going to be market perform. And the logic is pretty straightforward. We think this stock is basically going to be dead money, stuck in a range, let's say between $6 and $9. Until, and this is the key part, until management proves they can actually do what they say they're going to do. What we'll be watching for is simple. Do those profit margins start ticking up every quarter? That's the catalyst. The big risk, of course, is that they don't hit their targets, and even more customers head for the door.
This situation has a name on Wall Street. It's what we call a show-me story. And it's exactly what it sounds like. Management can talk all they want, they can make all the promises in the world, but the market's trust is gone. Investors are basically folding their arms and saying, don't tell me, show me. Show me the results. Until those hard numbers start coming in, the stock probably isn't going anywhere.
Okay, so for the last part here, let's have some fun. We're going to talk about our outrageous but plausible trade idea. Think of this like a hedge fund pitch. How would a professional try to make money off a situation as messy and uncertain as this one? The core belief here is that this company is not going to stay stuck in the mud forever. One of two things is going to happen. They either fix it, or this thing is going to fail spectacularly. The stock is going to make a big move, we just don't know which direction. So the play is something called a long-dated straddle. You buy both a call option and a put option, say 12 to 18 months out. Here's why. If the turnaround plan works, the stock could re-rate way higher and your call option makes a ton of money. But if the plan fails, the stock will fall and your put option pays off. You're not betting on direction, you're betting on a big move. You're betting against the idea that things will just stay the same.
And of course, we always have to say it, this is not financial advice.